If you're an accountant, this video is perfect for you. Today, we're going over the details of a solo 401k, so you as an accountant can better explain this to your clients. We're going to go through all the details needed so you know how to explain things to your clients very clearly. We're going to go through the who, the what, the why, the when, the where, and the how. The first thing we're going to go through is the who. Who will it apply to? Which of your clients will benefit from having a solo 401k? For a solo 401k, you must be self-employed business owner and have no full-time employees. A self-employed business owner meaning that you're a sole proprietorship, partnership, or S corporation. Now let's talk about the what. What is a solo 401k? It's a retirement account for self-employed business owners. Another thing that's important to know is that solo 401ks have a higher contribution limit compared to a traditional IRA and a SEP IRA. And the reason is because there's actually two separate types of contributions being made. There's an employee and an employer side. What's important to know for each of these contributions is the contribution limit, because for each one, there is a max that the client can do. For the employee contribution side, it will be the annual 401k limit, including catch-up contribution. Whatever year you're working on, make sure you know what the annual 401k limit is for each client. The second calculation is the employer contribution side. For the employer contribution side, the calculation is different depending on what type of business structure you have. For sole proprietorship and partnerships, it's actually going to be around 20% of the self-employment net profit. While for S corporations and C corporations, it's going to be 25% of the W-2 wages. And remember, when you're adding up the employee and employer side of the contributions, the total between the two cannot be more than the annual maximum allowed for retirement accounts. Now, let's go over the why. Why do we want to do this? Why should clients even know about this? There are two reasons. The clients are going to get a tax benefit and they're allowed to fund more towards their retirement. For tax benefit, the contribution that the client makes is actually a tax deduction. So it's going to lower their overall taxable income and they're going to pay less taxes. And the second reason why a client should do this is because they're able to fund more. They're able to fund a lot more compared to a traditional IRA and a SEP IRA. And by utilizing a solo 401k, the client's able to put way more towards a retirement account that's going to allow them to get the benefit of having a really large retirement account by the time they retire. So now let's talk about the when. What are the important dates that we need to know regarding solo 401ks? And this looks really confusing, but we're going to break it down into more manageable pieces. When it comes to solo 401ks, it really depends on the entity structure that the client has and also when they established the original solo 401k plan. So we're going to break it down. I'm going to show you the sole proprietorship and partnerships when it comes to important dates to know. So there are two scenarios. The first scenario would be when the client first set up a solo 401k plan. And for this newly set up plan, if it was done after December 31st, but before the tax filing deadline. The second scenario is when it comes to plans that's already existing, that has already been set up or has been set up before December 31st. For scenario one, the most common reason why this would happen is because the tax year has already ended, and when we're filing the tax return, maybe we mentioned that the client could participate in a solo 401k, and the client is interested in contributing the funds to the solo 401k so it could apply to the tax year that we're filing for. In this case, the client is limited on how much they could contribute because the rule for this is that the client could only contribute for the employer contribution, but not the employee contribution. So in this case, when the tax year has already ended and the client is still interested in putting into a solo 401k, it's possible. Just know that they could only put the employer contribution side. And for sole proprietorship partnership, this would be the 20% of the self-employment profits. This would be due April 15th. Now, if a client already had an existing plan, or maybe they set up a plan during the tax year, then they would fit into scenario number two. And in scenario number two here, this is when the client could actually put in the employee and the employer side, which allows them to really maximize the amount of contribution that they could put into their retirement. For sole proprietorship and partnership, know that the due date when it comes to the employee or the employer side of the contribution is going to be April 15th. Know that for sole proprietorship and partnerships, if they file an extension, they also extend the contribution due date to the new extension date, which is usually October 15th. So let's summarize. If the client set up a new plan that was after December 31st of the tax year that we're filing, then they could only put the employer contribution, which is going to be for sole proprietorship 20% of their net profit. And the due date on that is going to be April 15th. However, if they file an extension, it's going to be October 15th. And for clients who already had an existing plan or already set up the plan before December 31st, then they'll be able to qualify for the employee contribution and the employer contribution. Now let's go through S Corporation. Very similar to what the previous one that we went over. Anything that was newly established after December 31st to the due date of the tax return, that's going to be a new plan, and it only qualifies for the employer contribution side, which is for S Corp, it's going to be 25% of the W-2 wages. And then for existing plans, or it was established before December 31st, before the year ended, then they're going to qualify for both the employee and the employer side. For new plans established after December 31st, because they could only contribute to the employer side, that employer contribution is due March 15th. However, if they file an extension, they're going to get the extended due date of September 15th. Now, for plans that's already existing, there's going to be two different deadlines. For the employee contribution, we recommend that the contribution be made by December 31st. And the reason for this is because the employee contribution has to be reflected on the W-2, and the W-2 usually ends on December 31st. So we want to make sure that we have everything in by December 31st so it could be reflected on W-2 correctly. And the problem is that if the payment is made after December 31st, which is still possible, we just might have to amend the W-2 to reflect that payment. So just to make it easier, it's better to try to contribute the employee side by December 31st. So for the employer side, you could actually contribute a little later. It's going to be March 15th as the contribution due date. But if an extension is filed on the corporate return, and I would also suggest on the personal return, then the new contribution due date would be September 15th. So let's kind of recap this all over again for S Corps, is that if it's a new plan that was established after December 31st, but before the tax return due date, then they could only contribute the employer side, and the contribution must be made by March 15th, but if they file an extension, it will be September 15th as a new contribution due date. And for existing plans or newly established plan that was done before December 31st, then they could put into both sides of the contribution, employee and employer. For the employee contribution, the contribution must be made by December 31st so we can reflect it on the W-2 correctly. And the employer side of the contribution, this can be made by March 15th, but there's an extension filed, then it's actually September 15th that the contribution can be made. Now let's talk about the where. There's going to be two sections with this where. The first section is pretty much where it goes on the tax return, and the second one is where do clients go to set it up. For sole proprietorship and partnership, the solo 401k contribution will actually show on the adjustment to income page. However, for S Corporation and C Corporation, the employer contribution will show on the corporate tax return as a deduction on, there's a line item called pensions. For the employee side, this actually gets reflected on the W-2. So the way it works is that the W-2 will show a reduction in box 1 by the contribution amount. And then what you could also do is add in box 12 the amount of contribution so we know how much was contributed to the solo 401k on the employee side. Keep in mind that for S Corporation and C Corporation, the solo 401k contribution doesn't really show as a deduction on the personal tax return. It only shows the deduction mainly on the corporate tax return or through the W-2 wages. For clients who might be new to solo 401k, they might not know where to set it up. So it's our job to make sure that we point them in the right direction. And I usually let them know that, and usually banks, brokerages, and something called special retirement plan providers will provide solo 401ks. Now, the difficult thing is that with solo 401ks, I'm seeing that a lot of brokerages aren't handling them anymore because of the extra paperwork and extra costs that it comes with solo 401k. So we have to make sure that they find the right brokerage that will offer a solo 401k. And I normally recommend to see if their bank offers it first, since they're already banking with them, it's a lot easier to set up. But if their bank doesn't offer it, then they could go to one of the brokerage accounts to see if any of the brokerage accounts will set it up for them. If not, then there's always specialized retirement plan providers that do specialize in solo 401ks. Now let's talk about the how. And I feel like this is the most important part because this is the step-by-step instructions that we're going to provide to client to better serve them. As long as we follow this list, this will cover almost everything that we need to do when it comes to solo 401ks for our clients. So the first step is that we want to confirm eligibility and requirements, meaning that we want to make sure that the client qualifies for a solo 401k. And the first thing is making sure that they're a business owner, sole proprietorship, partnership, or S corporation. But not only if they're a business owner, but also are they showing profits? Did they take W-2 wages out if they're an S corporation? So we have to make sure that we do that, because if they're a sole proprietorship and they're taking a business loss, a net loss, then they won't be able to qualify for a solo 401k. They have to show a profit because the solo 401k amount is based on a percentage of the profit. And if they're an S corp owner, if they never took payroll, they never took a W-2 out of their S corp, then they can't do a solo 401k. The next thing is that we have to confirm the establishment date. We have to make sure, did the client already have an existing solo 401k, or is the client setting up a very new one to try to get the deduction now for the tax return filing? And for the last one, we just have to make sure that they make the contributions by the deadline. Now the next step is actually presenting the options to the client. We want to calculate what the maximum contribution is for the solo 401k, but we also want to provide lower amounts as well. So let's just say if their maximum amount is $50,000, we might want to say, okay, here are your options: $50,000, $25,000, $12,000, and $7,000. So we give them various options, so that way they know they don't have to contribute the max all the time, that they do have the flexibility to contribute a little bit, but as long as they know what the max is, and from there they could contribute a lower amount of whatever they feel comfortable with. And with the options that we provide, we also have to calculate the overall tax savings for each of those options that we provide, because the client needs to see what is the actual value that they're getting in dollars. Meaning that if I contribute $50,000 and I save $20,000 in taxes, is that something that I feel is worth it? So we have to make sure that the client sees that the different options that they are able to contribute, but also the tax savings for each one. So that way they could see an actual dollar amount of the benefits when it comes to their contributions. And after we run the calculation, we present this to the client and we show them the tax savings. So making sure that's easy to follow, easy to see, easy to understand for the clients to see, I contribute this much, I save this much. Once you present all the facts to the clients of how much they could contribute and the tax savings to it, the next step is that we need to confirm. We need to confirm a few things. We need to confirm that the client wants to make the contribution, if any, and how much they want to contribute. We need to confirm that the client has a solo 401k account ready, or that they already going to establish one, and that we need to confirm that the client will make the contribution or already has made the contribution on time. Once we get the confirmation of how much they contributed, that they do have a solo 401k set up, and that they really did contribute the funds to the solo 401k, then the next thing is that we can reflect this on the tax return and mark it correctly, whether it's on the S corporation or on the sole proprietorship adjustment to income page. But the main thing is that we have to make sure that we reflect it on the tax return as a deduction. An important thing to note when it comes to solo 401ks is that if the balance is over $250,000, there is an extra annual form that must be filed. The problem here is that not all brokerages will file this form for the client. Sometimes the brokerage will put it on the client to file it themselves. I had one client who didn't know about it, and their brokerage never filed the 5,500, and they got stuck with a $50,000 penalty, 3 years worth of penalties for not filing this form. Luckily, we were able to get it abated, but just know that this form does have to be filed if the balance of the solo 401k is over $250,000. Let's go through the pros and cons of a solo 401ks. And it's important to know these, but also important to share these with clients. So going in order, the pros or benefits of having a solo 401k is, like what we discussed, is the higher contribution limit. There is a Roth option as well. We normally don't recommend the Roth options to clients just because with the solo 401k, one of the main reasons is to get the immediate tax benefit. So that's why we don't usually offer the Roth option, but it's possible. And the next thing is that with the solo 401k, because it's considered a 401k, the client is actually allowed to take a loan against it. There are restrictions on the loan, but just know that it is an option where if the client wanted to take a loan against their solo 401k, very possible to do. Now let's talk about the cons, the not so great things about solo 401ks. And the first thing is the restrictions that if you're a business owner, that you can't have any full-time employees pretty much, because if you have full-time employees, it will disqualify you from having a solo 401k. And one of the biggest cons I think with a solo 401k is it's just more paperwork. It's a lot more filing. That annual form that you have to file if your balance is over $250,000, that's really annoying. But also this is more paperwork in general when you're signing up for a solo 401k. Because of those extra paperwork and because of those extra filings that's required, there's also higher fees, as the third point suggests. So just know that a solo 401k does have higher fees compared to a SEP IRA or a traditional IRA. So that does it for Solo 401k Accountant's Guide. Hopefully you found it helpful. Please give it a like, share it with your colleagues, and we're on to the next.